For everybody turning up for this one, and this is perhaps one of the more contentious issues with respect to the superannuation changes, and one of the least understood, unfortunately. Whilst I can understand what the government is trying to do, the actual mechanism for offering the relief is difficult to follow. It's imprecise in its wording, and there are certain issues which need to be carefully considered before providing any advice to a client. Now, clearly, at the moment, we have a position where the CGT relief available through the calculation of exempt current pension income within account-based pensions and such like. Because there's been an enforced movement of certain amounts from pension phase to accumulation phase, the government has determined that superannuation funds will be able to reset the cost base of the assets that are moved from the retirement phase into the accumulation phase prior to 1 July 2017. So it effectively ensures that the same outcome is achieved for those assets as if the fund had actually disposed of those assets whilst in pension phase. Now, there are some limitations to this, of course, because it only applies to assets that are moved between the 9th of November 2016, which was the date that the legislation became promulgated, and ends in the terminology just prior to 1 July 2017. And they refer to this as the pre-commencement period. And what it does, it's to ensure that when assets are sold and have been subject to the relief, when they're sold after 1 July 2017, tax is only paid on the capital gains accrued thereafter. The treatment of assets that are moved from pension to accumulation phase depends on whether the asset is a segregated current pension asset or an unsegregated asset immediately prior to the disposal. It also raises some interesting issues with self-managed super funds with respect to assets which are currently segregated and the potential lack of capacity to continue to be able to segregate after 1 July 2017. Interestingly, this also brings into account some issues to do with the so-called integrity measures, where the ATO is clearly looking at people who start up a second self-managed superannuation fund that may contain solely pension assets, and effectively you're creating a segregation when you may not be eligible for segregation. If we can go to the next slide, thanks, Sarah. There has been a number of issues raised after the draft Law Companion Guide came out late last year with respect to transition to retirement pensions. And bless their little socks, the ATO released the final version of the LCG document last Thursday after I'd completed writing the presentation. So thanks, ATO. What they've confirmed is that a transition to retirement income stream doesn't need to be commuted to the accumulation phase prior to 1 July 2017 in order to get the CGT relief when it's in an unsegregated fund. And I'll talk a bit about the differences between segregated and unsegregated as we go on. I've put a note in there that we're still unsure about what happens when a segregated fund comprises solely of a TRIS. It's an interesting one because technically a fund is considered to be segregated if it is 100% in pension phase, and the LCG document still doesn't give us any clarity with respect to the treatment of those transition to retirement pensions. Now, the important thing to realise is that the CGT relief is not automatic. The trustee must make an election and must choose for the relief to apply in, open quote, in the approved form, and would make a separate election to defer the gain if they wish to. It's important to recognise that because the timing of all of this is quite critical, and the fact is that you've got 2 elections to make. It could be that a fund chooses to make a choice, as I say, on an asset-by-asset basis, but it may choose to make absolutely no choice whatsoever, and that itself is a choice. Interestingly, the choice is irrevocable and must be made before the fund is required to lodge their 2016-17 income tax return. The Law Companion Guide also explained that the relief will be extended to funds which apply to the ATO for lodgement extensions. And it's not uncommon to see quite a lot of self-managed funds getting extensions from the 15th of May lodgement to somewhere around about the 6th of June. Now, the one thing you do have to be careful of, and what's not mentioned in the LCG document, is that newly created funds, in other words, a fund that, say, came into commencement on 1 July 2016, the lodgement date for a new fund is typically the 28th of February in 2018. Therefore, if you've got a new fund which commences during the 16-17 income year, you will need to be very, very careful about the lodgement of the election. If we can flip to the next slide, thanks, Sarah. Now, the mechanism that they're using is actually quite interesting because they're deeming a sale, which is CGT event A1, and it's followed by an immediate repurchase of the asset. Now, it does depend a little bit on the concept of immediate, because in one of the ATO documents it actually refers to 30th of June being the deemed sale and the 1st of July as being the repurchase date. So we go through and have a look at a lot of the CGT provisions that stand as a matter of course in parts 3-1 and 3-3 of the Income Tax Assessment Act 1997. And it explains the order in which we must deal with things and what we must do with respect to losses arising at the time of a deemed sale. Now, the important thing, where you've got a fully segregated fund or you've got segregated current pension assets, the gain or the loss is entirely disregarded. That's a very important distinction between a fund which is non-segregated and has both accumulation and pension interests. The capital gains in an unsegregated fund are partly disregarded under the proportionate method and may be deferred. And the deferral will be until the asset is actually physically realised at a later point in time. And again, the current losses on unsegregated assets are recognised in accordance with the current rules. And again, if you refer to section 102.5 of the Income Tax Assessment Act, it actually goes through the methodology and timing of dealing with capital gains and losses and how they are to be calculated. The interesting thing with respect to electing to uplift the cost base and to have the deemed sale and repurchase is that, of course, the 12-month period is reset before the capital gains tax discount can then apply within the self-managed fund. That could be particularly important for someone who may well sell that asset that they're considering applying the relief to within the next 12-month period. If we can go forward, thanks, Sarah. I'm quoting here now directly from the LCG document as it was finalised, and what the ATO is saying is that the object of the CGT relief provision is to provide temporary relief from certain capital gains. The interesting thing is that they also use the term "as a result of" in the object clause, indicating that there must be a direct connection between the actions a trustee takes and in order to comply with the reforms. Now, again, the law does not expressly restrict the relief to be applied under the proportionate method to those assets that have a total market value equal to the expected excess in members' transfer balance accounts. So, quick example, if a member had $2 million in a pension account and was required to commute $400,000 to the accumulation phase, what they're not saying here is that the CGT relief is expressly restricted under the proportionate method to those assets having a total market value of $400,000, for example. Neither is relief restricted to the total amounts members transfer back to the accumulation phase in anticipation of TRIS reforms. Now, as we've just also noted, that's one of the changes. We now don't have to commute if we don't wish to in order to get the CGT uplift for transition to retirement pensions. And now this is where they come with the big stick. A large difference between the expected excesses in members' transfer balance accounts on 1 July 2017 and the gains sheltered under the CGT Relief might indicate that the trustee has applied the CGT Relief for reasons other than a member complying with the transfer balance cap or TRIS reforms commencing. And that's a direct quote taken out of the LCG document. This is a particularly interesting point because it raises a number of issues with respect to Part 4A and risks to advisors that if they're not careful and they take the discretion too far, there could be questions asked by the ATO. There's been a number of questions raised with respect to exactly how much one can apply the relief to, and there's no clear answer on this. There really isn't a clear answer, and there's a number of reasons why you might apply the gains to none or a lesser amount than the excess that's transferred to accumulation. And in fact, you may actually wish to elect to take gains on a larger amount than the excess that's going to be created or the TRIS movement. And what the ATO has said is that schemes which do not do any more than it is necessary to comply with the reforms will not be the subject of determinations under Part 4A. Schemes which abuse the relief are another matter, and that's a direct quote from the ATO LCG document. And again, a choice is only a valid choice if it's consistent with the object of the CGT relief provisions. Now, there's been a number of commentators in the industry media that have come out, and in fact I've seen some technical articles, basically saying, well, you can go hell for leather, that you can actually apply the relief to all of the assets because the documents that have come out from the ATO basically say any or all of the assets are subject to the relief. I think it actually takes a little bit of further reading than the contemplation of applying the relief to all of the assets of a super fund, because clearly assets within the pension phase which are continuing beyond 1 July 2017 are still subject to CGT relief, whether they're segregated or unsegregated and using the proportionate method. So I'm not quite sure why you would actually elect to uplift within the pension phase assets that are continuing or an equivalent dollar amount in a proportionate methodology in order to take advantage of this temporary relief which is being offered. A question was raised as to, well, wouldn't it make sense if we had a death benefit subsequently paid out from the particular pension? Yes, I can understand the point there, but the ATO released a ruling in 2013, in June of that year, basically saying that the ECPI exemption will continue until such time as the lump sum is paid out, providing that lump sum is paid within a reasonable time frame. So again, you've got that continuity of relief being offered. My view, and this is purely my view at the moment, is that I would want to see a very valid reason as to why we would extend the relief offered to an amount greater or significantly greater than the amount which is required to be moved from pension to accumulation or the amount in a transition to retirement pension. Pardon me. Now, if we can flip to the next slide, thanks, Sarah. This concept of exempt current pension income is particularly important because it looks at the amount of income which is sheltered from tax within a superannuation fund. And we have three different methodologies that we can look at with respect to applying the CGT relief depending upon particular circumstances. We can continue to use the segregated method. If a fund has segregated current pension assets and segregated non-pension assets, we can continue to use that methodology up to 30 June 2017, and the continuation thereafter depends on the particular circumstances of the fund and the members. The majority of super funds, however, use the proportionate or unsegregated method, and that's pretty straightforward. You may also have a circumstance where a fund elects not to continue the segregated method up to 30th of June and may elect to go to the proportionate method. Unfortunately, this latter point can also be triggered by an inadvertent action by a member or an employer, for example, because if we have 100% pension phase within the superannuation fund and $1 of contributions is received and accepted by the fund, we have a case then where the segregation is lost. It becomes an unsegregated fund and subject to the proportionate methodology. Now, you may also have certain funds which segregate assets for investment reasons and to meet what might be declared in an investment strategy, where two members might have really quite different concepts about how they want their investments managed. The segregation that we're referring to here is the segregation of pools for tax purposes and the calculation of ECPI, not investment purposes. I've made an emphasis here about this fund which is 100% in pension phase. This actually is really quite critical because the loss of segregation from some of these funds can affect the date at which they may determine that funds are moved from pension to accumulation, because they don't necessarily get stuck with the 30th of June methodology. So ensuring a fund maintains its 100% pension phase categorisation is particularly important. And there's the comment there with respect to the loss of segregation if it receives $1 of contribution into the accumulation phase. Now, if we could flip forward to the next slide, thanks, Sarah. If we have a look, this is a fairly basic table that looks at what can be done with respect to segregated and non-segregated funds and how the trustee can apply CGT relief. Now, if we look at the segregated methodology, if the fund wishes to continue to use the segregated method during the pre-commencement period, the relief might apply to any assets transferred from the exempt pool to the taxed pool. And I've got some diagrams later which will explain a little bit more about what we're referring to with respect to the pools. The pools have to be quite distinct. There's been quite a lot of discussion over recent years with respect to, well, exactly what is segregation? When can it occur? How often can it occur or be removed from a particular fund? And what assets must be, how must the assets be held in order to maintain the segregation between the pools? This is an interesting one because if we're transferring direct equities, for example, we would need to create a separate HIN if we're moving assets from the segregated current pension income pool into the segregated non-current pool, the accumulation phase, in other words. But interestingly there, we can apply the CGT relief to any or all of the assets. Sorry, I'll rephrase that one. If the fund goes from being a segregated fund to an unsegregated fund using the proportionate method, we can of course apply the CGT relief to any or all of the assets in the exempt pool. And that's where things start to become interesting, because it could be that someone determines that in fact they don't want to continue segregation. They want to maintain the capacity to be able to apply the relief to any or all of the assets in the exempt pool. And again, where a fund is currently using the proportionate methodology, in other words, they've got an ECPI percentage of greater than 0%, any or all of the assets of the fund, except any segregated assets, start to become eligible for the CGT relief. It's starting to look a bit messy, which is unfortunately the methodology that the ATO has come up with and Treasuries have come up with. Pardon me. If we have a look at the next example on the next slide, thanks Sarah. Let's have a look at a situation where we've got a client who uses the segregated method. And we've got an example here of the values. that are contained in 5 assets within the fund. Now, we've got a total of $2.1 million of assets, and we've got a $480,000 unrealised capital gain. So there's a number of issues to consider. First of all is, well, would we actually wish to apply the capital gains tax relief to the asset number 3, which is showing a unrealised capital loss at the moment? Now, on the face of it, you would say that it's unlikely that you'd wish to apply a cost-based uplift to an asset which is showing a capital loss. And that should be a fairly good rule of thumb. You just don't apply the relief then. Now, there could be some valid reasons. I've yet to work them out, but there could be some valid reasons as to why you would wish to increase the cost base. But there you go. If this fund is 100% segregated, it only holds current pension assets. And so we could actually transfer assets into the segregated non-current pool. And the pension assets are still segregated. And don't forget, where you've still got segregated pension assets, you've got the capacity to ignore capital gains and losses. And we could actually do it in such a way that rather than transferring assets into a separate pool, we could actually just transfer the assets and not segregate at the point of transfer, and hence move to the proportionate methodology. If we go forward, we can have a look at some of the effects of what we're doing with respect to the particular assets. So if we have a look at asset number 2, which has got a cost base of $250 and a capital gain unrealised of $250,000, we could actually move that into the segregated non-current asset pool and apply the uplift so that the cost base becomes $500,000. There's no unrealised capital gain, and we've complied with the requirement to move $500,000 from the pension phase to the accumulation phase. So that's a fairly simple methodology, and you would tend to look at it and say, well, why wouldn't I move the asset with the largest capital gain and get that relief coming through? Valid point. If we go to the next slide, we can have a look at what might happen if we moved more than the $500,000 that's required to be moved into the accumulation phase. And again, you're looking at assets that have significant capital gains unrealised sitting in the segregated pool, and we can move those into the segregated non-current asset pool. It'd be interesting to find out from the advisors how many of them actually have and run funds that have segregated pools, because my gut feeling is that there would actually be very few of these. But the practical issues involved in actually moving monies from a segregated current pension asset pool into a non-current asset pool are quite considerable, and getting that action of transfer incorrect would involve the loss of segregation, and hence could be a potentially adverse taxation outcome for that particular client. Now, if we have a look at the next slide, which is slide 12, thanks Sarah, what we've done here is to move one parcel of one asset completely, which is asset number 1, and then we've taken several parcels of direct equities, for example, or units in a unit trust, and haven't moved all of the parcels, but some of the parcels for some of the assets. And we've still achieved the movement of the assets for the purposes of meeting the reform requirements, but we've picked and chosen the assets. Now, the purpose of looking at that particular slide is to say, well, it's not all the BHP shares, for example, that you would have to move into the segregated non-current pool. It could be parcels 1, 5 and 6, for example, out of the BHP shares that go across into the non-segregated pool. Sorry, the segregated non-current asset pool. I've still got to get all the terminology right. If we flick to the next slide, we can actually have a look at what happens with respect to the pools, because we've got a total sitting in there of $1.6 million in the account-based pension, $500,000 in the accumulation fund, And you can see there that you've actually got two discrete pools of assets. Therefore, we are fine. We have segregated current pension assets and segregated non-current assets. So we've complied with the segregation methodologies. If we can flick forward and have a look, the issue then raises its ugly head. Well, if we've got $1.6 million sitting in the pension, can we actually continue to segregate assets from 1 July 2017? And this is where, rather than just having a knowledge of the client's self-managed fund, you will need to understand a range of issues with respect to the client who may have an income stream sitting elsewhere in his global superannuation environment, and whether that is in fact in pension phase. So if at the prior 30 June, one member has a total superannuation balance exceeding $1.6 million, and that, of course, that figure will be indexed going forward, is in receipt of a superannuation income stream, and this will be a true retirement income stream, whether in this fund or another fund, and has an account in the self-managed fund that we're looking at, segregation will not be allowed to continue. And the comment I made before, the ATO will be closely watching to see whether an additional SMSF is set up purely to circumvent these segregation rules. And from what I'm hearing at the moment within the industry, the ATO have made this very, very clear to a lot of the admin staff within the ATO that there will be a matching of tax file numbers and newly established self-managed funds to determine the fact that people are not trying to get around the new segregation rules. Now, if we look at what happens where someone has maintained the segregation method in 1617 and they cannot continue thereafter, what we've got is a situation here where the total asset pool becomes the $2 million, $2.1 million, there's a typo, and with a $251,000 unrealised capital gain. And if we look at that and apply ECPI percentages going forward, we can determine from that that the unrealised capital gains tax would be $5,974 once those assets become realised. And the calculation methodology is 23.8%, representing the accumulation phase interests. 10%, we've assumed that we're going to be able to apply the discount on the total of $251,000. Now let's go forward. And what would happen if we switched to the proportionate approach? In other words, we could have accepted a contribution. We could have deliberately decided not to continue segregation. And we're having a look here at what might happen if we transferred all of the assets and applied the CGT relief to all of those. And you can see that we may not wish to apply it, of course, to that capital loss-making asset and would continue that on. And we've absolutely uplifted the cost base to a total of $2.25 million, representing the current value of 2.1 because of that $150,000 capital loss. So that's where it starts to become interesting, because again, what we've done there is we've transferred assets more than we're actually required to do in order to comply with the guidelines and the reform measures. So the question would arise, is this going to be attacked by the ATO as being a Part 4A issue? Let's go forward. If we do apply the CGT relief to all of those assets within the fund, we effectively arrive with an unsegregated pool of assets on 1 July 2017. All we have is $150,000 of unrealised capital losses. So that tax that we calculated on the unrealised capital gains in the previous couple of slides has disappeared altogether, and we have a carried forward loss of $150,000. You can start to see now where there's some issues that arise with respect to abusing the privilege of being able to apply the relief. If If we go forward to the next slide, this one I put in for all those opera buffs out there having a listen, and this is Tristan and Isolde's self-managed super fund. Now, this was a self-managed super fund that was unsegregated, and we had Tristan with an account-based pension of $2 million and Isolde with a $1 million accumulation balance. So we had an unsegregated pool of $3 million, and we had an unrealised capital gain of $155,000. Now, again, if we apply the any or all assets are subject to the relief, we can see here that we could get rid of that capital gain or the unrealised capital gain if we so wished. The point that I'd make is that Isolde is continuing in the accumulation phase. Tristan is going to have to move $400,000 into the accumulation phase, and he's still going to have the benefit of proportional relief on capital gains that are realised after the reforms take place. Let's go forward and have a look at this issue with respect to a self-managed fund using the proportionate methodology. So here's Tristan and Isolde's funds. What we've assumed here is that the capital gains tax discount applies to each and all of the assets, and the ECPI percentage is 67.7%, representing Tristan's position within the fund. And if we have a look here, what I've done is to look at a number of assets that have capital losses attached to them at the moment, unrealised of course, and assets that have unrealised capital gains. And in the middle of the table, I've gone through and I've made an election as to whether I wish to reset the cost base of those assets, what the uplifted cost base would be, and the assessable income that I would need to take into account in the 2017 year. Now, there's a number of issues that I can do with that, but let's look at the assessable income that we've got. So after application of the CGT discount and the ECPI percentage, we end up with a total assessable income in respect of capital gains of $93.2 million. Now, sorry, $1,000. We then look at the amount of tax that would be payable, and it's a tick under $14,000, which is the $93,200 multiplied by the standard rate of 15%, because we've already applied the discount to get to the assessable income. Now, the interesting thing here is that the trustee, of course, can not only make the election to undertake the relief, but they can elect to defer the capital gain by applying a further leg of the relief to that amount of tax that would be payable. So let's go forward and just reinforce a couple of the issues that we've looked at previously in the presentation. What we've said is that the election is irrevocable, must be made in the approved form and submitted by the tax return deadline. The non-exempt portion of the net capital gain is carried forward. And in the prior table, that was the $93,200. The amount is taxable at 15% in the year that the asset is realised. And the CGT discount and ECPI percentage will not apply to the $93,200 as they were already applied in the calculation in the 16-17 income year. Furthermore, the 12-month discount period is reset. So in other words, we've got another 12 months before we can apply the discount going forward. If we flip to the next slide and have a bit of a look at the implication of asset number 1 in the table. And so the trustee in this case has effectively elected to lock in a certain amount of tax, regardless of whether he also elects to defer the capital gain. Because if we look at it, we've got $22,200 in respect of the assessable income. At 15%, that gives us a tax bill of $3,330 after application of ECPI and the CGT discount. Now, a capital gain on that asset, when it is finally realised, will have the advantage of being able to apply the CGT discount and ECPI percentage at a later point in time. So the question starts to arise is, well, what's the likely position of the fund at a future point in time when we could be considering realising this particular asset? So let's assume that under this particular scenario, Isolde converts her balance to an account-based pension in a couple of years, and the fund's ECPI percentage becomes 85%, bearing in mind that Tristan still has retained a balance in the accumulation phase as a result of the reforms. So if we have a look at the situation where the trustee claimed the relief in 16-17 and elected to defer, in this particular scenario, if the asset sold for $400,000, we've got $3,330 of capital gains tax that's already been incurred, plus a further $1,500 based on the uplift from $300,000 to $400,000 in the cost base after the election has been made. Total of a tick under $5,000. However, in this particular circumstances, where there's been an increase in the ECPI percentage, the CGT relief exemption was not made. The capital gains tax that would be applied upon realisation would be $3,000. So we start to look at a number of rules of thumb as to what we may need to consider in making an election to take the relief, to defer the relief, or not to do anything at a particular point in time. So the good rule of thumb would be that in this particular example, where we had 67.7% originally as the ECPI percentage, where your expectation is that the ECPI percentage is going to increase over time, then you would seriously consider having a look at the rate of growth on a particular asset and making an assessment as to whether you would actually apply the relief where the ECPI percentage is going to significantly increase beyond where it currently is when applying the proportionate methodology. Now, if we have a look at some of the summary points on the next slide, thanks, Sarah. Bear in mind that it is reasonable to commute more or less than the minimum required to get to the $1.6 million cap, and also where you're applying the TRIS relief. Now, in some cases, you may actually not wish to transfer all of the expected excess above 1.6, because bear in mind you've also got the transitional measures that allow you to be able to rectify a particular situation. If you're within $100,000 of the $1.6 million cap, the amount is self-rectified within 6 months, and there is no other income stream commencing for that particular individual during that 6-month period. If any of those conditions are not met, then unfortunately the transitional relief, of course, is not able to be applied. Now, as we've pointed out, the final LCG document allows for a transition to retirement income stream in a non-segregated fund to remain in position without having to be commuted in order to obtain the CGT relief. And if we go back and have a look at a number of things that have been written and a number of articles that I've done with respect to this, I actually think that there's quite a number of reasons as to why you would continue a transition to retirement income stream without commuting, notwithstanding the loss of the tax exemption on the earnings. And that's one of the issues I'll go through in the next webinar. We're still awaiting clarification about a TRIS within the fully segregated fund, but again, that's been pointed out very quickly to the ATO, and we would expect to get some sort of clarity on that coming through fairly soon. I would always consider a number of issues with respect to application of the CGT relief. Certainly where there's an expectation of the exempt current pension income percentage increasing significantly beyond where it is at the moment. And there's also a number of issues that I've had a look at with respect to the calculation and determination as to whether I would apply the relief or advise a trustee to apply the relief on particular assets. So on the next slide that Sarah's got up at the moment, I've started to develop a tool which enables one to go through and determine a number of issues with respect. First of all, was the asset held on the 9th of November, the date of promulgation of the legislation? If the asset was, then you've got the capacity to be able to provide relief. If it wasn't, that's taken out of the scenario altogether. I've then gone and had a look and said, okay, well, do we want to exclude this? Well, yes, if the asset wasn't held on the 9th of November, I do want to exclude it from relief. I've also then considered, well, am I likely to want to sell this asset within the next 12 months? Because what I don't want is to have a higher unrealised capital gain post-relief that might be subject to no discounting. So I've taken that out of the scenario. I've then got some checks and balances in the spreadsheet that says, okay, this is eligible relief, and do I actually want to apply it? And then it goes through and looks at the issues with respect to, well, what's the capital gain, what's the gross gain, whether the gain is subject to a discount, what that discount is. And just for my purposes, I've put in an idea of what the capital gain is in percentage terms. So I can look at whether I pick and choose various parcels on that spreadsheet and make an election to defer that gain and to subject to the gain to the relief in the first place. The other interesting issue is that many of the examples that you'll see in the media at the moment consider circumstances where a fund has got unrealised capital gains only, not where there are unrealised losses and carried forward losses from prior years. This spreadsheet actually takes that into consideration in order to make the calculation. So in this particular circumstance, this was actually taken from a fund run by a broker of about $3 million, and there's $801,000 of capital losses. So in this particular case, we could comfortably say that the gains that we want to shelter can be quite easily sheltered, not by application of the deferral, but by applying the carried forward capital loss and the current year capital loss according to the methodology in section 102.5 of the Income Tax Assessment Act. And it's quite important to follow through that methodology and have a look at precisely how funds with existing carried forward capital losses are able to apply that against current year gains and current year deemed gains. And again, the Law Companion Guide actually provides a reference back to section 102.5 to ensure that when the gains are correctly calculated, they are able to be taken into consideration appropriately. The one thing that I'd say is, with respect to the proportionate methodology, it's my experience in the industry that there's been a lot of accountants who don't correctly apply capital gains and losses in the proportionate methodology. Technically, what is meant to happen with carried forward losses and carried forward losses is that existing current year gains reduce the level of carried forward losses for the determination of whether there's any continuing gain or what the level of carried forward loss would be, notwithstanding that there is a lack of tax proportionately on that capital gain that's occurred because of the ECPI percentage. I ended up having to sit down with one accountant some years ago and go through all of the funds that that accountant had on board, because in every single case, the manager who'd been doing all the self-managed fund accounts had incorrectly applied the methodology, and we had to go through and reconstruct what the carried forward losses should have been, bearing in mind that there'll also be some funds that have still significant carried forward losses continuing throughout from the GFC. There's likely to be some considerable issues with respect to being able to shelter those gains and not apply for the deferral going forward. So clearly in this case, where the fund is able to utilise the relief in respect of deeming the capital gain, it would make absolutely no sense in this case to also apply the relief to defer the capital gain to a future point in time when those carried forward losses may have disappeared through ordinary trading in that account. So there we go. It's a mess, and whilst I can understand why the government would wish to apply or wish to allow trustees to apply the relief, there are certain big sticks out there with respect to abusing the privilege of taking the relief. I had a bit of an interesting chat the other day to one of the biggest technical departments in the country. My view is that this could be simply resolved by applying a flat rate of tax across both the accumulation and the pension phases at a considerably lesser level than the 15% currently paid. This would then not involve having to make relief decisions and deferral decisions, and consequently the capacity for abuse of the system would be far more reduced than it currently appears that it could be. So I'll throw it open now to any questions or comments.
Well, thanks, Neil. Is there anyone got any questions?
Neil, Mark Finlay, you've spoken about self-managed super funds. The same would apply to Master Trust?
I had a chat to Macquarie about the application of their methodologies. It's going to be interesting because they're coming up with certain forms at the moment that will enable elections to be made. So if you had, again, $2 million sitting in the wealth accumulator, sorry, the pension account with Macquarie, and you had to move then 400,000 into the accumulation phase, the election has to be made prior to 30th of June, of course, and you need to work out what assets are going to actually be moved from the pension phase into the accumulation phase prior to the 30th of June. Now, the election will need to be confirmed by, we presume, the 31st of October, which is the date at which Macquarie would need to submit its returns to the ATO, as would any retail and industry fund with respect to their returns. So they are coming up with methodologies. I've spoken to BT about the same issues, and they're looking at exactly the same issues, but a little bit further behind Macquarie in determining precisely how they're going to handle this. Bear in mind too that, of course, coming up to 30th of June, there's going to be some significant service standard issues, as there always is, with respect to additional contributions coming in, people wanting to either commence pensions or stop pensions, etc., etc. I have a slightly sinking feeling that we're going to suffer some considerable service issues with respect to the administration of all of this, and it's going to be absolutely incumbent upon the advisors complying with the service standards that are going to be imposed by the providers and get the forms in on time. Now, has that completely answered your question, Mark?
Thank you.
Okay, so, well, look, Neil, thanks again for a very thorough presentation. Obviously, building on from the first one you did a couple of weeks ago, this issue is a rather technical one. There's a lot there that needs to be dealt with. I think the thing that we've really got to cut out of all of this is the advisor is going to be ultimately held responsible for things that do or do not happen in relation to this. We're very fortunate at Chartreuse that we've got a resource like Neil who is happy to work with you in assisting your impacted clients. So I would suggest that you need to get on top of which clients are impacted and then start liaising with Neil on what needs to be done to get the right resolution for these guys. I've already started to send a couple of people through to Neil because at the end of the day we're into March, so we're running out of time. So we need to get the ball moving on this. If anyone's got any sorts of queries at all, please pick up the phone and have a chat to Neil or myself. But it is crucial that we get going on the impacted clients. All right, Neil, thank you very much again for a very thorough presentation. And I believe we've got another one coming up in a couple of weeks.
Yeah, which is not on a public holiday, so we'll be fine.
Oh, okay. All right, very good. Well, thanks for joining us. Thanks again, Neil, and we'll talk soon.
Terrific. Thanks, Rob.
Thanks, guys.